Well, small investors are reportedly pulling out of the stock market following the Facebook fiasco concerning their initial stock offering.
But is it more than just those technical glitches and the insider tips at work here? Joining us this morning is Andy Barkate, our financial expert, to talk about the risks involved with playing the market. And I think that's the big word that people know, they see it, but they don't think about it.
That's a very good point you made. There's a couple of studies out there, a couple of research papers that are trying to talk a little bit about that.
Okay.
Maybe investors don't really do a good enough job of assessing the risk they want to take, or maybe voicing those concerns to their advisors, and maybe advisors don't do a good enough job of pulling that information out of their client. There's a disconnect there.
You think they're hesitant because they're thinking, man, I would love to take that risk and make that big hit, but then what if I don't, and should I be conservative?
Well, I think it's more the former instead of the latter. I think people are more worried about making money, and they don't really assess the cost that they may be taking.
Okay.
In a lot of cases, most investment advisors will use some sort of questionnaire to assess the risk their clients want to take. And apparently there's too much emphasis put on time horizon. In other words, how long you want to invest your money. Is it 1 year? Is your time horizon 1 year? Is it 21 or 31 years? And that somehow trumps a lot of the other questions that are more risk-based than anything else. In other words, you can maybe ask several questions and then answer everything very conservatively, hence you're a conservative investor. But if you say your risk tolerance is longer, somehow it just kind of kicks you out and still throws you more into the market. And in a lot of cases, people are taking a little bit more risk. They really understand that they're taking.
So generally, what is like a rule of thumb that people should be looking out for when they are looking to invest?
There's a lot of rule of thumbs out there. One of the most basic ones I think a lot of people have used over the years is the rule of 100.
Okay.
Your age, less 100. Say if you're 50 years old, obviously you're less 100, you're 50. Then maybe you can have 50% of your money in the market and 50% in safe investment. Now again, that's just a rule of thumb. I've always gone back to, what do you feel comfortable with? I mean, what do you understand? If you're very comfortable with the markets and you've been in them for a while, you have a pretty good idea what your risk level is, and you can assume maybe more risk. So even if you're 80 years old, you may have a large portion of your money in the markets because you understand that risk you're taking. And vice versa, if you're 20 years old
and have no idea what you're doing.
And right, and conventional wisdom says you should be a lot in the market because you've got time on your side.
Right.
In some cases, psychologically, you're not really prepared for that volatility that you will be facing over the long run.
That's very true. All right, Andy, thank you.
Thanks, guys.
For taking the risk this morning.
Keep your money in the middle of your mattress.